Welcome to the Opening Bell Report.
We are so glad you are here with us today to unpack something really quite extraordinary.
Yeah, glad to be here.
So our mission today is to extract the most critical, game-changing nuggets of knowledge from a highly compelling analysis report we've been reviewing.
And it's a fascinating one.
It really is. It focuses entirely on a microcap biotech stock with the ticker symbol MREO.
Right, MREO.
And the theme we are exploring today is essentially this: 800% upside potential. Why Wall Street is screaming BUY on MREO.
Which, I mean, when you hear that, it sounds insane.
Exactly. Okay, let's unpack this because we absolutely have to start with the hook.
We do.
The headline of this analysis report is the kind of thing that immediately triggers, your financial defense mechanism.
Right, your scam radar goes off.
Yeah, exactly. It points out an unbelievable 800% upside potential for MREO. Now, for anyone listening to this, when you see a number like 800% thrown around in the financial world, your natural instinct is probably to roll your eyes, assume it's pure clickbait, and just move on.
Totally fair reaction.
But the research points out a very compelling, mathematically grounded case that this isn't just hype.
It's really not. And it's crucial to ground this in Wall Street consensus reality right away, rather than internet speculation.
Right. Let's look at the actual numbers.
The sheer math of the situation is what makes that headline accurate rather than exaggerated. As of the data we're reviewing, MREO is trading at just 39 cents a share.
39 cents.
Literally a penny stock at this moment.
Yeah.
However, top-tier financial analysts covering the biotech sector have established a 12-month average price target of $2.63 for this stock.
Wow.
And if you look at the high-end estimates from these same institutional analysts, they're actually pushing past the $3 mark.
So when you actually sit down and run those numbers, the math is undeniable.
It's right there.
Moving from a current price of 39 cents all the way up to a target of $3 is a staggering surge.
Yeah, it is.
We are talking about an increase of roughly 669% on the lower end of that consensus, all the way up to that 800% figure.
Exactly.
It sounds astronomical, sure, but mathematically that is exactly what the delta between 39 cents and $3 looks like.
What's fascinating here is that this massive projection isn't based on current sales.
Which is usually how this works, right?
Right. Usually when Wall Street projects a stock going up by multiples, it's because a company is selling vastly more products or scaling their software or, acquiring millions of new users.
Scaling up.
But MREO is a clinical stage biotech company. They aren't relying on a steady quarter-over-quarter increase in revenue to justify this massive price target.
They don't have that kind of revenue yet?
No, not at all. Instead, this 800% upside thesis is entirely based on a massive, approaching binary clinical catalyst.
A binary clinical catalyst. Let's dig into that because it's the engine driving this entire conversation.
It really is.
It's essentially an event with two distinct, unalterable outcomes: a 0 or a 1, a pass or a fail.
Yeah.
The analysis report makes it very clear that the core of the entire MREO bull case rests heavily on one flagship asset. We are talking about a drug called setrusumab.
Setrusumab, right.
This is the billion-dollar orphan drug potential that has these institutional analysts so incredibly focused on a 39-cent stock. But to grasp the financial potential, we have to understand the science.
Precisely. To truly understand the multi-billion-dollar potential of setrusumab, we need to understand the underlying medical problem it's attempting to solve.
Okay, let's lay that out.
The disease in question is osteogenesis imperfecta.
Which is commonly abbreviated as OI, right?
Yes, OI.
Yeah.
Think about what osteogenesis imperfecta actually does to a patient. We call it brittle bone disease, and that is unfortunately not an exaggeration.
It's a horrific condition.
It's a rare, devastating genetic disorder that affects the body's ability to produce strong, healthy collagen.
And collagen is basically the scaffolding for bones.
Exactly. Without that scaffolding, we are talking about patients, often children, suffering severe traumatic fractures from just bumping into a table.
Oh, wow.
Or sometimes for no apparent reason at all.
And here is the most critical, almost shocking detail from the research that you really need to absorb.
Yeah, this is key.
Right now, today, there are currently 0 FDA-approved pharmacological treatments that address the underlying genetic cause of OI.
0.
None. Modern medicine can cast the broken bones, surgeons can insert metal rods to stabilize limbs, doctors can manage the severe pain.
But they're just treating the symptoms.
Exactly. There's no approved drug that treats the root cause to stop the bones from breaking in the first place.
That is the gaping, desperate hole in the medical landscape that MREO is attempting to fill.
And their solution is setrusumab.
Yes. And according to the clinical data in the analysis report, this drug is not just some theoretical concept sitting in a petri dish.
It's far past that.
It is currently in late-stage phase 3 clinical trials. Specifically, they're running two major global studies known as the Orbit and Cosmic studies.
And reaching phase 3 is a monumental milestone in the biotech world, isn't it?
It's huge. It means the drug has already passed the strict phase 1 safety hurdles. It has passed phase 2 dosing and initial efficacy tests.
Right.
And now it's being tested on a much larger global scale to definitively prove its clinical benefits against a placebo.
So why does this matter so much from a market perspective? The analysis report outlines exactly what happens if these phase 3 trials are successful.
It's a complete paradigm shift.
The FDA has set a clear bar. If MREO can prove statistical significance in these trials specifically, if they can prove that setrusumab significantly reduces the annualized fracture rates and noticeably improves bone mineral density in patients with OI, they don't just get a drug approved.
No, they get so much more.
They effectively corner an entire global orphan disease market.
And the term orphan disease carries massive weight here.
Let's define that for the folks listening.
Sure. It refers to conditions that affect a small percentage of the population. Historically, these diseases were financially unappealing for massive pharmaceutical companies to research.
Because the patient pool was too small to recoup the billion-dollar research costs?
Exactly. Because of this, regulatory bodies like the FDA offer significant, highly lucrative incentives for companies that successfully develop treatments for orphan diseases.
Like extended market exclusivity.
Right, a monopoly, basically. If MREO hits that statistical significance in reducing fracture rates, Wall Street is pricing in the very high probability that setrusumab will become the undisputed gold standard of care for osteogenesis imperfecta worldwide.
Which brings us right back to that 800% number.
Yep.
If you literally invent the standard of care for a devastating global disease that currently has 0 approved treatments, your company's valuation fundamentally changes overnight.
It skyrockets.
But I have to play devil's advocate here, because getting a drug through global phase 3 clinical trials requires a mountain of cash.
It certainly does.
And this leads to something the analysis report highlights that is incredibly rare, almost unheard of in this specific sector. Clinical stage biotechs are notoriously risky investments.
They are.
They are practically famous for constantly running out of money and destroying retail investor portfolios.
You were talking about the traditional biotech valley of death.
The valley of death, yes.
It's a brutal reality of the sector. A small company might have a brilliant scientific idea, but executing clinical trials takes years and costs tens, sometimes hundreds of millions of dollars.
To pay for the labs, the doctors, the patient monitoring.
And the massive regulatory filings.
Yeah.
The company usually has to keep issuing more and more stock or take on toxic debt.
Which dilutes everyone else.
Right. That dilutes the value of the shares held by existing investors to almost nothing before the drug ever reaches the market. It's a vicious cycle.
But the data we're reviewing points out that MREO operates completely differently from the typical microcap biotech in this valley of death.
They truly are an anomaly. They have what the analysis report describes as a financial fortress.
A financial fortress.
They have essentially de-risked the microcap aspect of their business model.
Right.
For starters, the company maintains a completely clean balance sheet with 0 debt.
I want you to really hear that. A tiny, pre-revenue clinical stage biotech company currently running global phase 3 trials with 0 debt on the books.
That lack of debt is remarkable. But it's paired with an even more impressive massive cash runway.
Let's talk about the cash.
The numbers provided detail that MREO currently holds roughly $48.7 million in pure cash.
That's a solid cushion.
But as any seasoned investor knows, cash alone doesn't tell the whole story. You have to look at the burn rate or how fast they're spending that money every quarter.
Right, because if they burn $40 million a quarter, that cash is gone tomorrow.
Exactly. But MREO maintains a highly disciplined quarterly burn rate of just $7.3 million.
Okay, let's do the math on that.
When you divide their total cash reserves by that quarterly burn rate, the math is incredibly reassuring. It means MREO has the capital to survive deep into the year 2027 without needing to raise another dime or dilute their shareholders.
That is huge.
They have bought themselves the ultimate luxury in biotech, time.
Here's where it gets really interesting. Because when you combine that rock-solid cash position with their current penny stock price, you uncover what the thesis calls an enterprise value anomaly.
Yes.
Let's walk through this math together, because it is staggering. Right now, MREO has a total market capitalization of roughly $63 million.
Which is tiny.
That is what the entire stock market collectively says this company is worth today. But remember, they are sitting on $48.7 million in pure cash in the bank.
Right. So when you calculate the enterprise value, which is essentially the true core cost to acquire the company's actual operating business and assets,
right,
you take that $63 million market cap and subtract the $48.7 million in cash they already hold.
Right.
That leaves an enterprise value of just about $15 million.
Think about that for a second. Let me use an analogy to make this crystal clear. Imagine walking down the street and seeing a gorgeous, state-of-the-art luxury real estate property.
Okay.
We're talking a massive, multi-story penthouse development in the best part of the city. Now imagine the asking price for that entire luxury property is the exact same price as a standard single-family starter home in the suburbs.
It makes no sense.
That is exactly what is happening here. The market is valuing MREO's entire pipeline, including a late-stage Phase 3 blockbuster drug that could literally become the standard of care for a disease with zero current treatments at the price of a luxury real estate property. $15 million.
It is profound inefficiency in the market. You're essentially paying an enterprise value of $15 million for a lottery ticket that has already made it to the final drawing stage.
Exactly.
A ticket that holds the potential monopoly on a devastating global disease.
But hold on, let me push back on this. The stock market is usually highly efficient, right? Thousands of algorithms and hedge funds are scanning for mispriced assets every second.
That's true.
So if the enterprise value is sitting at a measly $15 million, doesn't that imply that Wall Street secretly thinks the orbit and cosmic trials are going to fail? Why is the market pricing this pipeline for failure if the upside is so clear?
That is the exact right question to ask. In large cap stocks, yes, the market is incredibly efficient. But in the microcap biotech space, inefficiencies happen frequently because massive institutional funds often have market cap restrictions.
Red tape.
Exactly. They legally cannot buy a stock that is trading under $1 or has a market cap below $100 million.
So they're locked out.
Yes. So MREO is currently floating in this weird purgatory where the big money can't touch it yet, leaving retail investors and specialized funds to dictate the price.
And that creates the disconnect.
It creates these rare, massive valuation disconnects. But the analysis report doesn't stop at the standalone value of MREO. It introduces another massive layer to this thesis.
The wild card.
The M&A wildcard. And to understand MREO's ultimate endgame, you have to look closely at who is sitting across the table from them.
Yes, MREO is not running these massive global trials entirely in a vacuum. They are co-developing setrusumab with a partner company called Ultragenyx Pharmaceutical, which trades under the ticker symbol RARE.
R-A-R-E.
And Ultragenyx is definitely not a microcap struggling for attention. The analysis report points out that Ultragenyx is a massive $2 billion plus commercial giant in the biotech space with deep pockets and a massive sales infrastructure.
This partnership with Ultragenyx is the absolute linchpin of the buyout calculus.
Let's talk about that buyout calculus.
If the Phase 3 data from the Orbit and Cosmic studies comes back positive and proves statistical significance, MREO immediately transforms from a tiny clinical stage company into a highly lucrative, de-risked acquisition target.
Because the hard part is done.
Exactly. And the most obvious logical buyer is already partnered with them, co-developing the drug, and intimately aware of all the clinical data.
So let's talk about the financial motivations of a $2 billion giant like Ultragenyx. If setrusumab is approved by the FDA, MREO doesn't just get a pat on the back.
Not at all.
The partnership agreement entitles MREO to significant commercial royalties from Ultragenyx for the life of the drug. We are talking about a decade or more of massive top-line revenue flowing straight out of Ultragenyx pockets and into MREO's bank account.
If we connect this to the bigger picture, you have to look at the pure mathematics of corporate acquisitions.
Okay, break it down.
Let's say setrusumab becomes a blockbuster, generating hundreds of millions or even $1 billion in peak annual sales. Paying out a 20 or 30% royalty on that every single year for 10 years is an enormous financial bleed for Ultragenyx.
It adds up fast.
The analysis report details how it would mathematically benefit Ultragenyx much, much more to simply buy out MREO in its entirety the moment the Phase 3 data is de-risked.
Wait, so you are saying that even if Ultragenyx has to pay a massive premium to acquire MREO, even if they have to buy out the shares at that $3 or higher analyst target, effectively paying an 800% premium on today's price, it's still cheaper for them.
Absolutely. The upfront cost of acquiring MREO for, say, $300 or $400 million is mathematically vastly cheaper than paying out massive commercial royalties year after year over the next decade.
Because those royalties could total well over $1 billion.
Exactly. For Ultragenyx, acquiring MREO isn't just an aggressive growth strategy. It's a defensive, long-term cost-saving measure.
That makes so much sense.
They secure 100% of the drug's economics by writing one big check today, rather than bleeding royalty payments for a decade.
It's a fascinating corporate chess game. The logic is incredibly sound. But, as with any high-stakes game in the stock market, we have to look at the other side of the board.
We do.
So what does this all mean for the risks involved? The analysis report demands absolute candor about the harsh realities of the biotech sector, and we want to be completely clear with you about what happens if the science doesn't cooperate.
The term we used earlier is the most important takeaway regarding risk. This is a binary event.
0 or 1.
Right. MREO is the textbook definition of a make-or-break stock. The entire 800% upside thesis, the ultragenics buyout calculus, the standard of care potential, all of it hinges entirely on the phase 3 Orbit study.
And if that study fails?
If the data is unblinded and setrusumab fails to show a statistically significant reduction in fractures compared to the placebo group, the entire bull thesis is instantly broken.
And in that scenario, the market is unforgiving.
Very.
The stock will almost certainly re-rate downward incredibly fast. The data suggests it will likely fall until its market capitalization roughly matches its pure cash value of $48.7 million, or perhaps even lower as investors panic sell.
It's a steep drop.
That is the harsh reality of investing in clinical stage biotech. It is a scientific tightrope walk without a safety net.
Which is why, for those who understand the math, the science, and the binary risk, the analysis report emphasizes one crucial virtue above all else.
Patience.
Patience. Right now, the stock is basing near its 52-week lows. The research notes it's currently in what institutional traders call a low-volume accumulation phase.
Let's translate that for the listener, because low-volume accumulation phase sounds like a piece of jargon a hedge fund manager mumbles before taking your money.
Fair point.
What does that actually look like on the ground for this stock?
Essentially, it means the massive daily price swings and heavy trading volumes aren't happening right now. The big institutional buyers who do understand the $15 million enterprise value anomaly are likely quietly, slowly gathering shares on the open market without driving the daily price up.
Oh, I see.
They're positioning themselves quietly, just waiting on the sidelines for the trial data to drop.
And that is exactly why the analysis report is very explicit, that this is absolutely not a day trading momentum play.
Not at all.
You cannot jump in and out of this stock expecting a quick 10% flip based on a moving average crossover or a social media trend. The intrinsic value is locked entirely within the eventual release of the phase 3 clinical data.
You're waiting for that unblinding.
Until that scientific data is published and the world sees whether the drug works, the stock is simply holding its breath.
It's a perfect storm of financial metrics and clinical potential. You have a deeply undervalued asset with zero debt, $50 million in the bank, and a phase 3 drug targeting a devastating disease with no cure, partnered with a multi-billion-dollar giant, highly motivated to buy them out.
The pieces are all beautifully arranged on the board.
But as always in this sector, it all comes down to the science. The financial math is undeniable, the buyout logic is flawlessly sound, but at the end of the day, those molecules have to do their job in the human body.
That is the ultimate unyielding test. It really is an incredible snapshot of how Wall Street analyzes extreme risk versus extreme reward.
It's a masterclass in biotech investing, really.
As we wrap up our deep dive into this analysis report, we want to leave you with one final provocative thought to mull over on your own.
Something to think about.
If a massive multi-billion-dollar giant like Ultragenyx is doing the math and realizing that an outright buyout at an 800% premium is still cheaper than paying a decade of royalties, how does that fundamentally change the way we evaluate ANY small biotech partnerships?
That's the real question.
Are these massive, deep-pocketed pharmaceutical companies intentionally waiting for the tiny microcaps to shoulder all the brutal clinical trial risks, perfectly content to pay an astronomical premium later just to avoid the long-term royalty bleed?
It makes you wonder.
It makes you wonder if Wall Street isn't just betting on a drug's success, but rather betting on the inevitable buyout math of the entire orphan drug industry.
Don't forget to like, share, and subscribe for more.